because we do have a lot to get through. Today we're going to be discussing just how to deal with tax debt, but in using very different methods, like either trying to attack it directly with the IRS, or maybe if things become a little bit too much to bear, how could bankruptcy possibly be the solution there? So just, as a quick primer, my name's Heather Posey. I am joined by my colleague Uriel Stern. He is a bankruptcy attorney here at Frost Law. I am a tax attorney here at Frost Law. So we are teaming up to really tackle how people can deal with tax debt, both with the IRS and through bankruptcy. I'll skip all our bio slides because we will be sending out copies of this presentation afterwards and you'll have them. So today we're going to talk about the various methods for resolving tax debts directly with the Internal Revenue Service. We're going to talk about how tax debts and bankruptcy intersect and which tax debts are eligible to be discharged in bankruptcy and what affects what tax debts can be discharged. There's certain timing rules and there's certain rules regarding late filed returns that kind of affect how much you can discharge. So we're going to get through that in detail. And we're also going to be talking about how tax liens are treated in bankruptcy and when sometimes a tax lien might survive bankruptcy. So even if the tax debt is discharged against the person, that lien may survive. And it really controls the decision on if bankruptcy could be a viable solution to resolving tax debt. So I want to start out first with discussing the ways that you can resolve tax debt directly with the IRS, just completely outside of the sphere of bankruptcy. And one of the most common ways, of course, is an installment agreement, just a payment plan. You file a return, there's a balance due, or you file several returns, there's, kind of snowballing balances due, and it becomes completely just unobtainable to be able to full pay the balance. So in those situations, a good idea, probably the easiest way to resolve it is just to set up a payment plan. You're just paying the tax debt off over time. By default, it's usually over 6 or 7 years, usually 6 years. But in some situations, the plan can be stretched out further to get a lower monthly payment. And generally, to qualify for an installment agreement, there's a pretty, I would say, low barrier to qualification. You just have to be in current filing compliance. You have to continue to stay in filing compliance. And there are different types of payment plans. So there are essentially tax debt thresholds to some of those different payment plans. Like there's a streamlined installment agreement, which is just like kind of quick, automatic acceptance-ish for tax debt that is under 50 grand. And then for under 250, it's non-streamlined, but it's still like much easier to get in. And then outside of that, you can still get into payment plans, but it's just a little bit more complex. A lot more disclosure is needed. Now, once someone is in a payment plan, they are considered to be in compliance. So the IRS is not going to take any kind of aggressive collection action. They're not going to be levying bank accounts. They're not going to be garnishing wages so long as someone is able to keep up on their payments. Now, penalties and interest do continue to add up while someone is in a payment plan. So this balance is going to, even though you're making payments, it's going to continue to kind of grow, which is, a, I'd say a significant con of installment agreements, especially ones that are stretched out over a long period of time, because it means that you're going to be like have that burden on you for a significant period of time. And again, it requires future compliance. You have to stay current on all tax filings. You can't miss the filing deadline. And it does include extensions, but you cannot miss the filing deadline, and you have to stay current on payments. So you need to adjust your withholding to not incur future balances, or you need to be making estimated tax payments. If you incur a new balance, even as a result of maybe an audit, then you may be essentially like kicked out of the payment plan. They will threaten to terminate the installment agreement until you make it right. So there's still a lot of, like I said, it's really a burden that you carry on your shoulders for several years. And again, if you miss a payment, similarly to if you incur a new balance, the IRS can terminate the installment agreement, and that reinforces or restarts the enforced collection cycle. Now, in addition to just the regular, what's essentially what we call a full pay installment agreement, there's also a partial payment installment agreement. And this happens when the required monthly payment to full pay the balance due is still more than someone can afford. And in a partial payment installment agreement, the monthly payment is kind of tailored to what is affordable. And essentially, the IRS has a finite amount of time to collect the amount of tax that's due. Generally, it's 10 years after that tax is assessed. Now, there's certain actions that can extend that period of time, but by and large, it's 10 years. So, in a partial payment installment agreement, if you can only afford to pay $300 a month, but it would take $800 a month to full pay the amount of the tax debt over the life of that collection statute, what happens is you're just paying that $300 every month. And then once that collection statute of limitations expires, the rest of the debt just drops off. So it's a very, I would say, a good alternative for those who really cannot afford to just full pay their debt or can't afford a full pay installment agreement. But the kind of issue that comes in with getting into a partial payment installment agreement is if you say, oh, well, I can't afford X amount per month, the IRS doesn't just take your word for it. You have to prove it. You have to give a very detailed financial disclosure. There is like a huge, essentially, packet of information that you have to send in. The form is called like a 433A for individuals, 433B for businesses, where you're disclosing all of your assets, all of the liabilities that you have in terms of personal loans and credit cards and mortgages and vehicle loans, and essentially any encumbrance against your assets. You have to report all of your income from all sources, what you are getting each and every month, or if you're only getting something annually, then it just gets like prorated over the year. And then you're reporting your monthly expenses. Now, the IRS also has what they call like national standards for certain expenses, where if your monthly expenses happen to exceed what the IRS deems a reasonable amount for, maybe housing or food and clothing, etc., then you may have to prove that you have special circumstances that justify you having to spend more, or else the IRS is essentially going to say, okay, maybe you're spending $5,000 a month on your mortgage and utilities and etc., but for your area, we only allow 3,500 or something. So they are essentially going to like add that remaining money back into your net monthly income. So it can be very challenging. It's not impossible, but it's challenging. And in partial payment installment agreements, the IRS can and sometimes does reevaluate someone's ability to pay. So if they see that maybe your income has gone up significantly, or maybe you're acquiring new assets, selling assets, etc., they may want to um, adjust the partial payment installment agreement because, of course, the IRS wants to get as much money as possible. So they do partial payment installment agreements for tax policy reasons, but they are not bound by the terms of the initial agreement if your financial circumstances change. Now, again, like I mentioned, the amount of debt normally is not fully paid in a partial payment installment agreement. You just are making the payments each month, and whatever is left over after that CSET expires, it's gone. And like a regular installment agreement, it stops any kind of enforcement action, so no garnishments, no levies, etc. But again, it's subject to the same terms of a full pay installment agreement where you have to stay in filing compliance and paying compliance. Otherwise, they will terminate it. So for those for where a payment plan is maybe not an option or maybe not affordable, there is the infamous offer in compromise, where the IRS essentially is willing maybe to settle someone's debt for less than the full amount based on kind of like a lump sum offer, where you're essentially saying, hey, this is all I can afford. Um, can we just settle the debt for this amount? And there are three different types of offers and compromises. There is the debt as to collectability, which is the most common one. And it's essentially just saying that, hey, I don't have the funds or assets to be able to pay the full amount of the tax due. This is what I have. Can we settle it for this? And then there's doubt as to liability, where you are trying to say that, hey, I owe this money, but I don't think I should. I don't think that this assessment is right. I think it should be less, or I think it should be nothing. And I want to do an offer in compromise based on that. And then finally, there's effective tax administration. This one I think is one of the most difficult, because in these situations, this is when someone has enough assets or money to be able to pay the tax in full, but it would cause a significant hardship for them to have to pay over those funds. I think the poster child for effective tax administration would be perhaps a disabled person who has more than enough equity in their home to pay for the tax liability, but they don't have enough monthly income to be able to afford getting a home equity loan, and they can't really sell the property because they're disabled. They've already had the property modified to be accessible for them, and it would not be easy by any stretch of the imagination for them to be able to acquire a similarly accessible property. And in those situations, it doesn't promote a fair tax system to force that person to hand over that equity just to pay the taxes. So similar to a partial pay installment agreement, offer in compromise requires a very extensive financial disclosure. And in doing that, the IRS actually calculates what they call your reasonable collection potential. Your reasonable collection potential is your equity in assets, your net equity in your assets, plus your net monthly income. And that net monthly income number is multiplied by either 12 months if you do like their lump sum offer, or 24 months if you do like the longer periodic payment offer. And you just kind of add all that together, and that is what your offer is supposed to be. Your offer needs to at least equal that reasonable collection potential. And if the IRS does accept your offer in compromise, there are very strict terms for compliance. Like you have to stay current on all tax obligations. You have to make timely estimated tax payments. You have to have sufficient withholding. You have to file all your returns on time. And this is for 5 years after the offer in compromise is accepted. If you default on that, they will essentially retroactively deny your offer and they will reinstate the balances due. So that is more of a long-term effort to continue to be compliant. It is just a term of them accepting your offer. Now, again, when you submit an offer in compromise for that time period that your offer is pending, all aggressive or enforced collection action stops. Now, it could start again if the offer in compromise is rejected. But while it's pending, at least there is this temporary halt on collection action. Now, offers and compromises are very complex, and there is a lower acceptance rate than what certain advertisements may lead you to believe. It really requires very careful preparation and very thorough analysis of all assets anywhere, because the IRS has tools at their disposal to look at public records and see what assets may be tied to someone, and you can't hide anything on the offer and compromise application. Like you have to be incredibly truthful. So sometimes it can be very complicated. Now, another thing to note is that if your equity in assets plus your net monthly income multiplied by the number of months that is left on the collection statute for that debt, if that figure is equal to or greater than the amount of the tax debt, then the offer will be denied no matter what. Because the IRS essentially is thinking, hey, your net monthly income is this. If you were on a payment plan, we could get the full amount of the tax debt. So it's really not in the best interest of the government to accept an offer in compromise to get less of that tax debt. So in those situations, they will deny the offer. Something that kind of goes hand in hand, I think, with offers and compromises, because you can look to either one depending on the circumstances to see which is right, is currently not collectible status. And this is more of an administrative decision by the IRS to just temporarily halt collection action due to a hardship that the taxpayer is experiencing. So this is more so when someone is unable to meet basic living expenses, like their net monthly income is 0 or a negative number, and they have limited equity in assets. Or sometimes you could argue that those equity and assets are necessary for the taxpayer to continue to provide for themselves, either in retirement or to pay for medical expenses, etc. Again, this requires proof of the financial hardship through that full financial disclosure that is reflecting all assets, liabilities, income, and expenses. It does stop active collection efforts, but you will still receive like annual balance due notices. Any federal tax liens will remain, or if they have not been filed already, they will be filed because the government wants to still protect its interest while they are not taking collection action against someone. And again, the debt stays and it continues to grow with interest and penalties. So it's not a great solution for just a short-term reprieve, possibly, because depending on the amount of the debt, it could balloon exponentially during this time. And just like partial payment installment agreements, it is subject to periodic review. If someone's income increases drastically, they're selling or purchasing assets, the IRS may revoke their currently not collectible status or not essentially call, but require someone to prove that they are still experiencing a hardship. Any tax refunds that come in will be offset towards that tax debt, but that's essentially the extent of the collection action that happens. And a good thing about currently not collectible status is even though the IRS is not taking collection action against them, that collection statute of limitations just continues to run. The time or the clock continues to tick, and eventually the debt will drop off. And then another resolution, this one just depends on the timing of like when the IRS threatens to take enforcement action against someone. Normally, when the IRS first threatens to levy someone's assets, they get a notice that affords the right to a collection due process hearing. Because under the Constitution, the government cannot take your life, liberty, or property without due process. And in a collection due process hearing, you get the opportunity to say, hey, levy action is more intrusive than necessary. It's inappropriate. We can resolve this through alternate means, and alternate means being payment plan, currently not collectible, offering compromise, I don't owe this tax, something of that nature. So it does suspend collection activity while you are in this, like while you have a pending collection due process hearing request. And once you go through the collection due process hearing, if the appeals officer decides, hey, I think levy action is appropriate because you have not proven to me that you should be able to get into a payment plan or that you're eligible for an offering compromise, etc. If you get an unfavorable determination from them, you can appeal that determination to the tax court. And it's one of the few, I would say, kind of like collection requests that you can actually bring in to tax court. And again, like I mentioned, you have a forum to propose collection alternatives, and they are very motivated to try to get you in to some kind of collection alternative. They don't want to do levies or garnishments. It doesn't look good for the IRS. It's aggressive. It takes a lot of effort. They want voluntary compliance, and appeals officers are generally very amenable to that. And in some circumstances, you can dispute the underlying tax liability, but it's more so if you didn't get a prior opportunity to do so. However, there is a very short window of time to be able to request a collection due process hearing. You have to request it within 30 days of the date the IRS sends a specific type of notice of intent to levy and your right to a hearing notice. If you, like, once that 30 days passes, you don't get the right to a collection due process hearing, and the IRS can still take enforced collection action. Now, if you are late in requesting a CDP hearing, you can, within 1 year, you can request an equivalency hearing. So it's the same hearing where you are just proposing some type of collection alternative, and it's still with the same Office of Appeals, and they still want to get you into a collection alternative. But the only issue is that it does not suspend collection action. So if the IRS has threatened to take enforcement action, even though you request an equivalency hearing, those collection actions might still continue. Like your wages may still be garnished until you have the equivalency hearing and until you can get into a collection alternative. So there's no legal hold, but you can still get your case before an appeals officer who can kind of take fairness and equity into account in getting a good resolution. So in contrast with resolving tax debt through bankruptcy, If you resolve it with the IRS, of course, you're avoiding these harsh IRS actions in terms of levies, garnishments, etc. You have a little bit more control of what you propose to the IRS and what the terms of the agreement versus kind of this involuntary enforcement of collection. Sometimes it can have a better outcome than bankruptcy, specifically if those tax debts would not be dischargeable. And the payment terms, of course, you can kind of customize to your ability to pay. So there's more flexibility in that. It can, of course, preserve assets that if you were to go into bankruptcy might have to be liquidated, and it resolves just the tax issue. So if there's not really a lot of other debt out there or any other issues that could be resolved through bankruptcy, then it might be more beneficial to try and resolve it directly with the IRS. And anytime that you do resolve it with the IRS, it's going to prevent any kind of like escalation or any kind of delays with getting like just IRS issues as a whole resolved. All right, Uriel, I think this one's you.
All right. Hi, everyone. I'm Uri Stern from Frost Law. I'll give you a little bit of insight into how bankruptcy deals with taxes. Just a heads up, it's not a one size fits all in any case, and there's so many details, so you have to be really careful and make sure you have professionals like Heather on hand to help you out. So bankruptcy is something that is used to get rid of all different types of debts, not only tax debts. So if you're struggling with tax debt and other debt, then it's a good option to consider possibly. But you have to take everything into account and see what the bankruptcy will eventually accomplish at the end with respect to all the debts, not just the tax debt. Upon the filing of a bankruptcy case, the automatic stay of 11 USC 362 goes into effect, and it prevents all creditors, including the IRS, from continuing collection actions. There are, however, exceptions to this, especially with respect to the IRS and some of the things it can still do, even while the automatic stay is in effect. The other thing to take into consideration is that because of the automatic stay, some of the limitations are told during this time period, which can extend the time period by which the IRS can continue to collect non-dischargeable debt after the bankruptcy is concluded. I think we can go to the next screen, Heather. So the bankruptcy petition creates a bankruptcy estate under 11 USC 541, and the bankruptcy estate is very broad, and just about every property ownership interest that the debtor has comes into the bankruptcy estate. It does in Chapter 7. Property acquired after the filing of the petition is generally not part of the estate. There are some exceptions. The most notable one is an inheritance received that is due to the debtor by someone who dies within 6 months of the filing of the petition. That could be part of the bankruptcy estate and has to be taken into account. So tax refunds are part of the bankruptcy estate, and with respect to Chapter 7, I think there are different ways of dealing with refunds. What I tend to do, if necessary, is you can actually prorate the refund based on the time of the filing. So if it's the filing of the bankruptcy is, in June, July, so you're at about 50% of the year is done, you can prorate the estimated tax refund and only take 50% of it as property of the estate, and then exempt it, as we'll discuss in a little bit regarding exemptions. In chapter 13, there's also a couple different ways of dealing with tax refunds. If a client is someone who generally gets a large tax refund and they don't want to give that up, then you have to include that tax refund on Schedule I, which is where you include all the debtor's income. So you divide the tax refund by 12, include it as income, and then hopefully you have expenses that can eat that income up. Otherwise, you do have to turn over the tax refunds to the trustee every year. Married people are the only ones who can file joint bankruptcy cases. And while it does double some exemptions, each individual debtor is still limited only to their the amount that the exemptions provide. So I can speak as to Maryland. There is an exemption, basically a wild card exemption of $5,000. So in a joint case, the $5,000 is doubled to $10,000, but as to each individual's property, they can only exempt up to $5,000. So if there's a vehicle with too much equity, let's say $15,000 of equity owned only by one of the debtors, then there will be non-exempt equity that will have to be dealt with, either liquidated or paid out through the Chapter 13 plan. Also, as far as I know in Maryland, unless something has changed recently, the homestead exemption, which we will discuss in a little bit, it can only be used by one debtor. And I believe there's also a time limit. If one part of the couple files bankruptcy and uses the homestead exemption, it cannot be used for a number of years after that by the other part of the couple. The set off is a very important part of understanding bankruptcy. If a creditor holds money that belongs to the debtor when the bankruptcy is filed, the creditor can actually offset the debt by that amount of money that they are holding. So we see it sometimes with credit unions, that if you have a checking account with money in it and the bankruptcy is filed and the debtor also owes money to the same credit union for a debt, the credit union can set off the amount. The IRS similarly can do that with tax refunds that are due to the debtor. They can, even if a debt is discharged or dischargeable, they can still take money from the refunds that are due to the debtor to set off the amounts that are due. We can go to the next slide. You're on mute, Heather.
Sorry, I just wanted to add, in the tax context specifically, the set-off principle is used a lot of times by businesses where maybe they owe a lot of money in taxes, but they're a federal contractor and there's some money in accounts receivable from a different federal agency, then those can kind of cancel each other out. We see it being used a lot right now in bankruptcy cases for businesses who owe tax debt but are still owed some money from the IRS for the employee retention credit or any other kind of outstanding refunds. So they will kind of set off each other to kind of come to a net, either net refund due or net tax owed.
And the next slide. Oh, that is the next slide. So the way I explain this to my clients is that when someone files for bankruptcy, the law doesn't leave them, on the streets with nothing. They're allowed to keep a certain amount of property, even though they're filing for bankruptcy. And even though bankruptcy is federal law, when it comes to exemptions and other matters in bankruptcy, you have to turn to state law to figure those things out. So exemptions in Maryland, I can tell you, as long as you're in Maryland, you have to use the Maryland exemptions, which are in the Maryland code. So you use exemptions in order to ensure that property doesn't get liquidated by the trustee. There are also exemptions that are unlimited. So in Maryland, we have, like I said, there's a $5,000 wild card exemption, but there's also unlimited exemptions for most retirement plans, 401ks, IRAs. Equity in real property or in people's homes that they use varies widely by state. How much of that is exempt? I can tell you in Maryland, it's $31,575. I believe in Florida and Texas, they have some sort of unlimited homestead exemption, so lucky them. But you always have to keep that in mind. Vehicles, some states have specific amounts you can exempt in vehicles. Household goods, public benefits are always exempt, like Social Security and disability. However, property exempt in bankruptcy can still be used to satisfy IRS debts after the discharge. So even though you were able to exempt it in bankruptcy, you still have to consider what may happen after the bankruptcy. Federal tax liens can still be enforced against exempt property even after taxes are discharged. But Heather, you'll correct me if I'm wrong, they can't be enforced against after acquired property. So
Yeah.
yeah. We can go to the next slide.
Yeah. Like Yuri just mentioned, they can't be enforced against after acquired property because after tax debt is discharged, the debtor themselves is personally discharged from liability. But a lien operates as like this kind of imaginary hold on a specific piece of property where the IRS is asserting its right to either the equity in that piece of property or the proceeds from the sale of that piece of property specifically. So the IRS's lien against that property may stay, but the debtor themselves is kind of relieved of liability. So after acquired property, there's no lien against it, it's fine. Now, sometimes the IRS may decide to take collection action against property that during the bankruptcy proceeds was essentially exempted from the bankruptcy estate. Most commonly, this is going to be retirement plans, since those are oftentimes considered exempt under essentially public policy reasons from being part of the bankruptcy estate and having to be liquidated and paid over to creditors. Now, the IRS does not do this often to go against exempt property, but they have a very established framework for doing so, and it has happened before. We've seen it happen before. So I think it's something that still should be on the radar of someone who may be considering bankruptcy. That now going after someone's retirement plan is not it's not in good, I guess it doesn't reflect well on the IRS. It is many times not really equitable. People need these assets in their retirement plan to pay for their basic living expenses in retirement. So the IRS does not take it very lightly in terms of attempting to collect against exempt property. When someone is going through bankruptcy and the tax debt is discharged, there's normally an internal analysis by the IRS where they look at how much equity is in the exempt property, and they kind of analyze how much harm would it do to the taxpayer if we were going to try and take that property, specifically, especially with retirement plans, like how close are they to retirement? Are they still pretty young and can they recoup this? How much tax did they actually owe? Like, is it going to be worth the amount of money and effort that the IRS spends trying to collect any type of equity in that retirement plan? Um, and then they're also going to analyze what they refer to as flagrant conduct, specifically with retirement plans. They are looking at, did the debtor intentionally try to hide assets from the IRS? Did they intentionally delay collection action prior to bankruptcy? Were they maybe being very difficult with IRS collection employees? But also, they're going to look at if someone continued to contribute to their retirement plan while actively incurring new tax debts or while already having an existing balance. So essentially, the IRS is saying, hey, you owed all this tax or you continued to incur all these balances which you have not paid. And instead of paying us, you contributed to your retirement plan. Obviously, contributing to your retirement plan is not a moral failing, but it's something that the IRS takes into account when they decide whether or not they want to go after exempt property. And even if the IRS goes through all these factors and they decide, yes, it would be worthwhile for us to try and collect against their property, they will send a like a soft contact letter first. Someone from the bankruptcy insolvency unit sends out this soft contact letter and says, hey, we have a lien against your assets, and some of these assets were exempted in bankruptcy, and you owed all of these taxes, so we are considering enforcing that lien. And they kind of invite the taxpayer to maybe contact them and initiate like a voluntary settlement. They, of course, do not want to go through the process of enforcing a levy against a retirement plan. It's better if they can, better for equity's sake and for efficiency's sake, if the taxpayer can just voluntarily pay over a portion of that equity. And they will, maybe take into account the taxpayer's current and future financial circumstances, maybe when they may retire, et cetera. Like, you can still make arguments about their net equity and assets, et cetera, similar to how you do with partial pay installment agreements and offers and compromises. And you can come up with a settlement of, okay, I will withdraw X amount from my retirement plan, pay it over to you, and we can just consider it done. And that's essentially what they're looking for. They're hoping to get voluntary compliance, but they may enforce it if not. And again, this really does not happen often at all. And the circumstances have to be right where someone is probably like younger and it's not going to hurt them so much to take these assets and they were engaging in flagrant conduct, et cetera, et cetera. But it is something to still think about if the majority of your equity and assets is in a retirement plan. And if it could be a significant risk, then it's something that should be at least taken into account before filing for bankruptcy. So once someone files for bankruptcy, there is this automatic stay on collections for all creditors. But for the IRS specifically, they are, of course, barred from initiating any kind of collection action, at least as it relates to the current tax debt. They can't seize any properties. They can't file a new notice of federal tax lien. They can't make an additional assessment in relation to a tax liability that is currently part of the bankruptcy. They can't issue notices of intent to levy, or they can't issue a notice of determination in a CDP hearing. If someone is already litigating a tax liability in tax court or like a lien related proceeding in tax court, then there's essentially like a stay on that case. Now the bankruptcy court can order like, hey, you need to lift the stay so that they can determine the correct amount of tax liability, etc. But automatically there's like a stay on the tax court proceedings. They cannot accept voluntary payments or payment plan payments towards pre-petition taxes, and they cannot attach an IRS lien to assets that are inherited after the bankruptcy petition is filed. They can still do some things. They can demand that a debtor files their tax returns. They can audit any tax return. After an audit, they can issue a statutory notice of deficiency. Now, the debtor is not allowed to file a petition to challenge that deficiency in tax court until the bankruptcy proceedings are over, but the IRS can still issue one. The IRS can assess uncontested liability. So essentially, if someone files a voluntary tax return and there's no challenge to that assessment, the IRS can assess it. They can assess taxes and issue notices and demand for payment of those assessments. Like if a business is filing employment tax returns, they can refile a notice of federal tax lien. They can't file a new one, but they can refile an old one. They can, of course, offset tax refunds against other liabilities. They can issue and enforce administrative summons, and they can revoke a nonprofit organization's tax exempt status. Now, because of the automatic stay on collections and sometimes on assessments, it creates some issues for relevant statutes of limitations on collections and assessments because they cannot take any collection action during the period that a debtor is in bankruptcy, and in some cases can't even make an assessment. During that time period that they are barred from doing so, those collection statutes and assessment statutes are going to be tolled. So the assessment statute is tolled from the time that automatic stay is pending plus 60 days. Now, this doesn't apply to voluntarily filed returns that someone files during bankruptcy, but it's for other things, like if you have a case in tax court. The collection statute is told from the time the automatic stay is pending plus 6 months after the order of discharge or that the case is dismissed from the bankruptcy court. So because of this, it makes bankruptcy, again, a tactical decision because you need to balance how much debt is going to be dischargeable versus how much tax debt would survive the bankruptcy. And it might not be worth filing bankruptcy yet if some of that debt is close to expiring, or if the majority of the debt is otherwise non-dischargeable. So when we talk about tax debt that can be discharged, there are 3 rules that tax assessments have to meet in order to be eligible to be discharged. The first is the 3-year rule. So the tax, that return had to have been due more than 3 years prior to the filing of the bankruptcy petition. And this includes extensions. So if someone gets a valid extension of time to file until, maybe October 15th, then the 3-year rule is going to be like 3 years after that October 15th date. There is the 2-year rule where that return has to actually have been filed more than 2 years before the filing of the bankruptcy petition. So even if the return was due, 4 years ago, but you didn't file it until 3 days ago, then that tax is not going to be eligible for discharge. And then there is the 240-day rule. So the tax has to have been assessed more than 240 days before the filing of the bankruptcy petition. Now, in normal circumstances, if a return was due more than 3 years ago and it was filed more than 2 years ago, that tax has been assessed. It's normally assessed like at or around the time of filing. And the 240-day rule is more so looking at assessments that are made after, like additional assessments that are made after, if the return is audited and the IRS finds a deficiency, if the IRS's like automated under reporter system finds it, oh, hey, you forgot to report this W-2 or this retirement distribution, and they make an assessment, then that second or separate assessment had to have been made more than 240 days before the filing of the bankruptcy petition. Now, each of these calculations is subject to its own tolling events, which can further increase the amount of time necessary until tax debts can be discharged in bankruptcy. And we are going to get into those right now. So the 3-year rule, the tax debt is dischargeable, like I mentioned, if the tax return was required to be filed more than 3 years before the filing of the bankruptcy petition. So essentially, you're just like looking at the bankruptcy petition date and you're going back 3 years. Now, this includes valid extensions, like I mentioned, but this rule is told by the amount of time that the taxpayer was a debtor in prior bankruptcy proceedings, plus 90 days, and the period of time that someone has submitted a request for a collection due process hearing until the IRS Office of Appeals issues a notice of determination, plus 90 days. Now, I want to note that this applies to collection due process hearing requests that are filed after a notice of intent to levy, but not those that are requested after a notice of federal tax lien. Or actually, Uriel, do you have anything to add?
I do not have one on that.
Okay. All right. So the 2-year rule, this one is actually not subject to any tolling events, which is good, but there's still some intricacies. So like I mentioned, under the 2-year rule, the tax is dischargeable if that tax return from which the tax liability relates was filed more than 2 years before the filing of the bankruptcy petition. So something that's important here is what qualifies as a return for the 2-year rule purpose. So in essence, it's any return that satisfies the Beard test under the Beard case. So in that case, the court determined that a return is any document where the information needs to be sufficient for the IRS to calculate the liability. It must purport to be a tax return. It must be an honest and reasonable attempt to comply with the tax laws, and it has to be signed by the taxpayer under penalties of perjury. So in that regard, when the IRS does a substitute for return under 6020A, these are more like automatic substitute for returns where the IRS calculates everything and they just send something to the taxpayer. Taxpayer doesn't act, they don't respond, they don't petition the tax court, anything like that, and then the tax is assessed. Substitute for returns do not meet the Beard test because they are not signed by the taxpayer under penalty of perjury. Now, audit reports also can be equivalent to a return because they are signed by the taxpayer. When the taxpayer accepts the audit report, that may qualify here. Oh, I'm sorry, I got these mixed up. It's returns that are prepared under 6020B, the ASFR unit. Those are the ones that are not dischargeable. But under 6020A, An IRS employee, typically a collections employee, will prepare a return and then give it to the taxpayer for the taxpayer to sign and say, okay, yes, I agree with this assessment or I agree with this return. Because they are signing that return under penalties of perjury, it then meets the Beard test and then can be discharged in bankruptcy. Now, the 6020A substitute for returns are nowhere near as common as the normal 6020B, just like automated substitute for return issued by the IRS, and that's it. So in those situations, that assessment is just not subject to discharge ever. The only exception is if the taxpayer, if the IRS does a substitute for return, and then afterwards the taxpayer files an original return, and that original return reports a higher tax liability than what the IRS had computed. That additional assessment can be subject to discharge, but the underlying assessment made as a substitute for return cannot be discharged. It's just if there's an SFR under 6020B, it's just essentially non-dischargeable. Oh my gosh, it's 12:58. Okay, I gotta hurry. All right, 240-day rule. Like I said, this rule is told by the amount of time that the taxpayer was a debtor in prior bankruptcy plus 90 days. If the taxpayer has submitted an offer in compromise, the period from the submission of the offer in compromise until it is accepted or rejected plus 30 days tolls the 240-day rule. And then again with CDPs, it's from the filing of a CDP request until a notice of determination is issued plus 90 days. Also only applies to notice of intent to levy and not notice of federal tax lien. All right, we could maybe skip this because, essentially taxes eligible for discharge is just the non-priority debt, like the ones that we talked about just now. Yuri, do you want to add anything?
Yeah, I think
Okay.
any taxes that meet those three conditions will be non-priority tax debt, which can be discharged in bankruptcy. Just a summary.
All right.
However, the last note there I think is important, that the tax liens still exist against the property. So even though the personal liability is discharged, the tax liens still remain and can be collected from that property.
Yeah. But as a defensive measure, you can also review the federal tax lien that was filed and see if there's any errors in it, if it was filed in the wrong county, or if it was filed like, they didn't have the taxpayer's name right, maybe. Then you could potentially defend that that lien is invalid to be enforced against the taxpayer's property.
You want me to do this one, Heather?
Yeah, you can do it, or we can skip it.
Any of those? Essentially, well, I think it's important to note that what happens in Chapter 13 plans and Chapter 13 cases, if the IRS is secured by a tax lien, that debt does have to be paid in full through a Chapter 13 plan in order to confirm the Chapter 13 plan with interest. Something to really keep in mind when creating plans for your clients, that has to be paid in full. Some clients can have a tremendous amount of tax liens that have to be paid within 5 years. So it's just something to really keep in mind. Same with any priority non-dischargeable debt, also has to be paid even if they don't have a lien. If let's say the taxes are due from last year, that has to be paid also within the Chapter 13 plan.
All right. So there are some taxes and penalties that, even though they may meet those 3-year to your 240-day rules, they still might not be able to be discharged. So that's going to be all trust fund taxes that are assessed against businesses and trust fund recovery penalties that are assessed against businesses or individuals. Like I mentioned, taxes assessed under 6020B via a substitute for return, taxes and penalties relating to fraudulent returns, or taxes for which the taxpayer willfully attempted to evade or defeat the tax, orders of restitution in relation to tax evasion prosecution. So essentially, for those, there's what's called non-pecuniary loss penalties, where it's not a penalty that's essentially trying to make up for the tax or something like that. It's more of like punitive measures. Um, those are not going to be dischargeable.
You want me to pick this one up?
Yeah, sure.
So some states income taxes may not be discharged. I know in Maryland that's not the case. As long as they meet those rules, it's the same as the IRS. Same with trust fund taxes owed to the state. I think the rules apply the same as they do to the IRS, although maybe states follow different rules. I've actually never come across that. Actually, I think, to come to think of it, trust fund taxes in Maryland owed to Maryland are not dischargeable. I don't, I guess some states, if you file the return late, you're done. In Maryland, that's not the case. This is just a general, the means test in bankruptcy determines whether or not you qualify for a Chapter 7. You have to compare the debtor's household income for it to the household income for the household of the same size as the debtor in the state in which they reside. If the income is lower than the median income, then they can qualify for Chapter 7, although there are other things to take into consideration, like whether a liquidation will take place if a Chapter 7 is filed. If the income is higher than the median income for the state in which the debtor resides, you have to continue on to what I call the second part of the means test, which is a determination of whether the debtor has enough income after payment of certain allowable expenses to pay a certain amount of the debt that they owe. Like we said earlier, homestead exemptions vary wildly by state. Florida generally exempts all equity in home in the debtor's primary residence. Maryland, you can exempt 31,575 in the primary residence. Also to keep in mind that depending on the debtor's movement prior to the case may affect where they can file, but not only where they can file, but what state exemptions apply. There's the bankruptcy code requires certain residency requirements before you can claim a certain state's exemptions. So it's to prevent forum shopping, exemption shopping, I guess. Moving to Florida and buying a brand new house. Well, that's not, and then filing for bankruptcy won't work. So you got to keep that in mind.
All right. And then lastly, just kind of overall, some considerations of when maybe bankruptcy may be a better method to resolve tax and other debts versus when it might not. So if a large portion of the tax debt is dischargeable, bankruptcy might be a great way to resolve it. Or if there's other debts that could be either discharged or just better managed in a bankruptcy proceeding. When the collection statute limitations are, if it's still fairly long on dischargeable debt, then bankruptcy could be a good alternative. If it's about to fall off and that's kind of the only tax debt that there is, it might not be worth all the time and effort to do bankruptcy proceedings and then potentially extend the statute of limitations if there's any error with the bankruptcy, such that not everything is discharged. If there's other assets that can be protected, or some could be liquidated, and that's fine just to get the fresh start that bankruptcy provides. And then if other defensive measures like challenging the assessment are essentially off the table. So we can do Q&A. I know it's like 1:07, so I don't want to impose too much on everyone's time. At the same time, we're also going to launch a poll where you can just kind of like tell us what you thought, give us some feedback on this presentation. We would really, really appreciate it. I think this was our first time giving this specific topic in our spotlight, so we would love to know just your thoughts on it.
And Heather, do you know if we will be sending out the slides and a recording?
Yes, we will send out the slides and a recording as well.
And Heather, there are a few questions in the question and answer section.
Okay. Oh, here we go. Okay. Okay, so the difference between a 433A and a 433F, like there really isn't much of a difference. I find that IRS collections has been requesting 433Fs more often. I learned on 433As and I just always use them. I think they're very clear in terms of getting to the net monthly income amount and giving a good disclosure of all the income and assets. Like it just seems more intuitive to me. So there's not much of a difference. I think 433F is a little bit more taxpayer friendly, but that's it. Okay, so for partial payment plans, if you disclose that you own property but have very little cash flow, will the IRS make you sell that property in order to make the monthly payments? I would say yes. Oftentimes it's yes. Sometimes we can make an argument that maybe either you can't access the equity, or that equity is needed to provide for basic living expenses if the cash flow is like very, very minimal or negative. It makes things more difficult for sure, but it's not impossible by any stretch of the imagination to essentially get into a partial payment installment agreement and still protect equity. Does Fed compliance include state compliance? When it comes to everything with resolving tax debt with the IRS, it does not include state compliance. Uh, All right, I'm doing Kelly's. I have a client who took over a business from his mother after she passed in 2017. The business had an overpayment on 2022 941, which was applied to a 2007 older liability that the client was unaware of. Requested transcripts that indicates that there was an installment agreement established in 2011 with payments for only a few months. The taxpayer was blocked motivated levy, additional tax assessed 2017 of 0. Yeah, they use that transaction code additional tax assessed very freely to mean many different things that have nothing to do with assessing tax. But I think it's sometimes like getting an amended return or processing an amended return or some kind of just like contact from the tax. They use it for a lot of things. So the account is in CNC right now. How is the IRS still able to attempt collection 2025? I don't think it's because of the phantom tax assessment. You know what I would do? Send me an email, but I really think that a Freedom of Information Act request would be very good here to see when that 2007 liability was assessed and what the IRS's essentially like internal calculations of the collection statute of expiration is. Or I would also try to call the PPS business line. Probably start there before a FOIA because the FOIA will take a while to come back. But I would call the IRS PPS line and say, hey, there's this liability on here. Like what was the collection statute of expiration? Like what is the outstanding balance? Why is it still being collected, etc. I would start there. If the 10-year CSIT expires and you did not file bankruptcy and the IRS filed a lien, does the lien still attach to property in existence or is the taxpayer in the clear? even though the property they owned before the CSA expired is free from IRS enforcement. Normally, in that situation, the lien, it's not like it expires, but many times it will self-release. They're usually supposed to file something with the county to like release or withdraw the lien, but often, especially right now, the federal tax liens that they file just have a sentence on them like this tax lien is self-releasing or will release on X date. And that date normally ties to the collection statute of expiration date. And then in that situation, that's why if the CSAD gets extended by tolling events, then the IRS will refile it. But if they don't refile, then it just kind of like self-releases and is no longer valid. Give us an example of tax debt owed for 6 prior years and files bankruptcy. That one might be kind of hard because I'd have to go through like,
I think we would need more details of
yeah.
the tax
All right, can
history.
you still request a cap hearing after receiving a notice of intent to file a federal tax lien if the IRS is still shut down? Yes, you definitely can. I am still filing CDPs, I'm filing other appeal requests, I'm filing whatever, just to, even though nobody's there to answer the phone or to read the mail, I'm still sending it in so that I'm sending in my stuff timely. When a client requests CNC through the CDP hearing process and the appeals officer finds that someone can pay 200 to 300 a month, does the IRS then garnish that amount from their bank account monthly? No, what they would do is the appeals officer would say, hey, okay, so you can pay, between 200 to 300 a month. Let's set you up on an installment agreement for 200 to 300 a month, like whatever that figure is. And whether that's a full pay installment agreement or a partial pay installment agreement, they set up a formal payment plan where the taxpayer says, okay, I want to make my payment on this day of the month each month. And then they can either do direct debit installment agreement where the IRS does take it out of their account each month, but that's with the taxpayer's consent. Or the IRS can just like mail a notice to someone each month, like a bill, and then they just send a paper check. There's no like forced garnishment in there. Does the 10-year statute of limitations apply to trust fund taxes? Yes, it does. If you had an installment agreement which withdrew monthly payments directly from a bank account, and then the IRS stopped taking the money out for unknown reasons, if you do nothing and the 10 years passes, can the estate escape the debt? I would want to research that just in case. I have an inkling, but I just want to research whether the estate would kind of have this duty to do that or not. I work in the medical field. Should I always request of my contractor to be 1099? So whether you receive a 1099 or a W-2, it's not supposed to be based on like the consent of the worker or the decision of the employer. It's supposed to be based on the law. The IRS and like state departments of labor have kind of set out these criteria for defining a worker relationship and doing what they call worker classification, where if the employer is like has a lot of control over you, like they set your hours, you don't have the discretion to say I'm not working that shift or I'm not taking that shift, etc. I'm not going to do that. Um, but if you get to do that, if you're bringing your own tools, your own supplies to the job site, if you can hire subcontractors to help you perform these jobs, then in that situation, you're a contractor. But when the employer kind of has a lot of control over you, then you are considered an employee. So it is, of course, you know, sometimes now more beneficial to be treated one way or the other, but unfortunately we can't choose that treatment. We just have to kind of follow what the law is like. I think I think I answered all of the questions. Really rapid fire. Um, all right, well, if there's no more questions, then yes, we can just call it a day.
Thank you, everyone, for joining
Yes.
us.
Thank you, everyone who joined. Really appreciate your participation. And we will see you all next time.